It's a popular refrain. The stock market is rigged. And honestly, there's truth to it. But it's not rigged in the way many people think. The conspiracies about asset managers secretly controlling everything, or Wall Street being a monolithic cabal manipulating markets, are distractions from the real ways the system is tilted. The market isn't rigged to keep individual investors out. It's rigged in ways that reward the biggest players, exploit inefficiencies, and capitalize on human behavior. Let's dig into how it actually works. How high-frequency trading, HFT firms don't control the market, but they certainly have an edge. These firms use ultra-fast computers and algorithms to execute trades in fractions of a second, far faster than any human could. Here's how they win. Imagine you place an order to buy a stock. An HFT firm might intercept that order, buy the stock first, and sell it to you for a slightly higher price, pocketing the difference. This practice, called latency arbitrage, happens in microseconds and generates billions in profits for HFT firms. Is this illegal? No. Is it fair? That's debatable. HFT firms argue they provide liquidity to the market, making it easier for everyone to trade. But critics point out that this advantage creates an uneven playing field. Insider trading is the classic example of a rigged market. It's illegal to trade on non-public information, but proving it happens is difficult. The bigger issue, though, is the gray area of legal insider knowledge. For example, executives and board members can legally buy and sell their company's stock as long as they follow disclosure rules. Hedge funds and analysts often get access to expert networks where they gain insights from industry insiders. While not technically illegal, these practices give some players better information than others, allowing them to act faster and smarter. For retail investors, this means you're always a step behind. By the time news hits the public, institutional investors have already moved the market. Even if you've never heard of HFT or insider trading, you've likely felt the effects of another rigged aspect of the market fees. From brokerage commissions to fund management fees, Wall Street has built a system that takes a cut of every transaction. Even in the age of free trades, brokers often make money by selling your order flow to market makers, a controversial practice that lets others profit from your trades. Then there's the issue of mutual funds and ETFs. Many actively managed funds charge high fees, even though most fail to outperform simple index funds over the long term. This fee structure quietly eats away at your returns while padding the profits of fund managers. Perhaps the most surprising way the market is rigged is against you, not by Wall Street, but by your own psychology. The stock market preys on human emotions, greed, fear, and overconfidence. Consider this: most investors buy high and sell low. Why? Because they get swept up in the excitement of rising markets and panic during downturns. These emotional decisions fuel volatility and often lead to poor returns. Large institutional investors know this and design their strategies accordingly. They thrive on market overreactions, buying when everyone else is selling and selling when the crowd is euphoric. Who really wins? In the end, the market isn't rigged to ensure your failure. It's rigged to reward those who understand its mechanics. Institutional players, high-frequency traders, and well-informed investors thrive because they have the tools, knowledge, and discipline to exploit inefficiencies and avoid common traps. For retail investors, the key isn't to fight the system, but to understand it. Avoid chasing hot stocks, minimize fees, stay disciplined during market swings, and most importantly, recognize that the market's rigging isn't personal. It's systemic. the good news, once you understand the rules of the game, you can play smarter and maybe even win.